Hello and welcome to part 1 of our multi-part lecture series on the topic of time value of money, which is a subsection of engineering economics. Learning objectives of this lecture include understanding time value of money, and in this lecture we will focus on 2 out of 4 components. The first one is the present worth and the second one is future worth, and annuity and gradient, which are the other 2 components, will be discussed in the next lecture. Time value of money. Time value of money illustrates that the value of an amount of money changes over time. So you would have probably heard this common saying that you don't become rich by saving. Saving basically safeguards you against risk, against unknown scenarios, so that you can actually weather the storm. But in order to become rich, you'll probably have to invest your money. As I mentioned, within time value of money, there are 4 components that we need to look at. The first one is present worth. So this is basically what we are most commonly used to. So the amount of money that we have in today's dollar, right? But then the amount of money we have today, if we hold it in a simple checking bank account, it won't be equal to the money will not have the same value in future. And we will also introduce 2 relatively more complicated concepts of annuity and gradient in this lecture. So let us start our discussion with present worth. Present worth, as I mentioned, refers to the value of money in today's dollars. So at times it is useful to convert future values and annuities to a present value for comparison or cost evaluation. And we'll go through a few examples where we'll actually do that. Because when you compare everything in today's dollars, it becomes easy to make decisions and it becomes easy to evaluate different options. So there are various factors that we will look at when it comes to each of these: present worth, future worth, and annuity. So the first factor for present worth is called the single payment present worth, which basically converts the value, a future value, to present value. So let's say somebody gives you $100 in future, so 10 years from now. So you'd be interested in calculating what those $100 are worth in today's dollars. So as you know that money loses value over time, right? So the $100 10 years from now will actually not be the same as $100 today. So you will use the single payment present worth factor in order to calculate that. So this goes by, you want to calculate P given F. Okay, so this is how you can read it. So you want to calculate P given F with an interest rate. So this interest rate would be specified, and N, I already told you, is 10. The next factor is called the uniform series present worth, and it basically converts annuity to present value. Now in the previous example, let's say that if someone was giving you $100 every year for n is equal to 10 years, right? So if $100 are being given to you in year 1, in year 2, in year 3, all the way up to year 10, right, in each of these years, then how can you actually convert all of these payments, these annuity payments that are being made to you, into one lump sum value in today's dollars? Okay, we can do that by making use of the uniform series present worth factor, which calculates P given A. A is the annuity. You have to know the interest rate and you have to know the number of years. So the number of years I've told you over here is 10, and the interest rate would be specified. So all of these payments, all of these annuity payments can then be converted into one single payment in today's dollar using uniform series present worth. Let us now take a look at example number 1 related to present worth, and we are being asked to calculate how much will $1 million from 25 years in the future will be worth today at an annual interest rate of 4%. So my approach when it comes to these cash flow type of problems is always to visualize them or create a rough diagram. So we have $1 million. Okay, $1 million 25 years from now, and we are being asked to calculate what they will be worth in today's time. Okay, if the interest rate is, annual interest rate during this period is 4%. So we know that $1 million today is not equal to, so today's $1 million is not equal to yesterday's $1 million or tomorrow's $1 million. And by yesterday, I don't literally mean yesterday, I mean several years from now in the past. and several years from now in the future, okay? Because money loses its value over time, okay? So this is an interesting problem. So we have a single payment scenario, okay? So we have single payment in future, and we want to convert that into present. So we will use the single payment present worth formula, which is the P divided by F, and the present worth will be equal to $1 million time the factor, and that factor P divided by F, it depends on the interest rate, and N, and this is where your NCEES FE reference handbook interest rate tables that are given in engineering economics sections will come in handy. You can actually calculate it using the mathematical formula that is given there, but I recommend you to get familiar with the reference tables because that will save you a bit of time, and some of those calculations are actually pretty complicated and you can make mistakes. Anyway, so we will write it as P divided by F, 4% and 25. So if you go to the 4% interest table, look at the entry N is equal to 25, and under the column P divided by F, you'll find that the factor is 0.375. So $1 million for 25 years from now at an interest rate of 4% is just $375. Now, if you were to look at it a little bit differently, let's say you had $375 today, and then you are gaining an annual interest rate of 4% on it each year. So 25 years from now, that will be worth $1 million. So see, money is changing value as we move across the spectrum of time. So $1 million 25 years from now are not the same as $1 million today. A lot of people understand this concept, but then there's another parameter, which is the annual interest rate. So the interest rate really determines how much value money is able to hold over time. Example number 2 involves an annuity. So we have to calculate the present worth of a 25-year term, $100,000 annuity if the interest rate is 4%. Okay. So when we are dealing with annuity, so basically means that payments are being made or you are being paid on an annual basis. So in this case, 100K is what the annuity is basically paying, okay, for 25 years. And the interest rate I is equal to 4%. So your A is equal to annuity, which is $100,000, and your N is equal to 25. So again, we need to calculate the present worth. So we need to find P given A, okay, and our interest rate is 4%. So we will take a look at the 4% table, and N is equal to 25. So you'll find the column P given A in the interest rate table for 4%, and at entry number 25 on the row, you will basically be able to find the factor. So the formula that I just explained to you is a uniform series present worth formula. You don't necessarily need to remember the names. You need to remember these factors, okay? So P is unknown, and A is provided to you. So we will use P given A, and this happens to be the uniform series present worth. So you will multiply the annuity, okay? This is an important step. You don't simply calculate this factor. You multiply the annuity with the factor in order to calculate the present worth. So $100,000 paid to you every year for a period of 25 years, during which the annual interest rate is 4%, is the same as paying you $1.56 million upfront today. Okay, so this is the time value of money. So in the previous example, we went from a future value to the present value, and in this case, we are going from an annuity into the present value. Future worth. Future worth refers to the value of money in future dollars. At times, it is useful to convert present values. So P is the present worth or present value, and annuities, annuity is given by A, to a future value for forecasting, planning, and cost evaluation purposes. For example, if you're doing your retirement planning, then you would be looking at the investments that you're making today in tomorrow's dollars, right? So that's where the future worth comes into play. And similarly, if for capital projects, if a large amount of money is being allocated to a particular project, then we would want to see what would be basically the return on investment. So the return on investment calculations use future worth, planning uses future worth, budgeting and cost evaluation and forecasting. So it obviously has it is a very important concept within engineering economics, and it is largely used in project management as well. The first factor that we're going to look at for future worth is called the single payment compound amount, and it basically converts a present value to a future value. So you have an annual interest rate of I%, and N represents obviously the number of the compounding periods, and F given P will basically calculate F, okay, such that you're given a present value. So again, coming back to a very basic example, if I give you $100 today, okay, or if you get $100 from someone, then if somebody tells you that, okay, interest rate is 10%, okay, for the next 10 years. So what will be the future value of this $100 10 years from now? And then we can also make use of annuity in order to convert it into the future, and that becomes a uniform series compound amount. So it converts annuity to future values, and it is denoted as F given A, interest rate, and the number of compounding periods. Now let us look at an example involving future worth. This is example number 3. It's asking us to find the future worth of $1 million 25 years from today if the interest rate is 4%. We can use the single payment compound amount formula in order to calculate this. So P, as I mentioned, is given to you as $1 million, N is equal to 25, and I is equal to 4%. Okay, so we will multiply the present worth and with this factor, single payment compound amount factor. So only F is unknown. So you'll basically jump to the interest rate table for 4%. You will look for this factor F given P in the columns, and in terms of the row, you will basically look at N is equal to 25. And this happens to be 2.66. So you multiply 2.66 with $1 million and you get $2.66 million. Okay, so that basically means that today's $1 million, okay, is equal to $2.66 million in future if the annual interest rate is 4%, 25 years from now. Example number 4, calculate the future worth of a 25-year term $100,000 annuity if the interest rate is 4%. Now in this case, your I% is 4%, your A is the annuity, which is $100,000, and the term is 25 years. So someone is paying $100,000 each year for 25 years. So if we want to get a lump sum payment and the interest rate is 4% annually, if you want to get a lump sum payment instead of this $100,000 each year, and that lump sum payment will be paid to you in year number 25, at the end of year number 25, then what will that amount be? We can use the uniform series compound worth formula, which calculates F for us if A, I% and N are provided. So remember, in all of these formulas, you actually have to multiply whether it is a present worth. So it was present worth in the previous example and the annuity in this example. Okay. So what you're going to do, you will basically go to the 4% interest rate table, look for this column. Okay. And you will find row number 25, N is equal to 25. And that factor ends up being 41.64. So you multiply 41.64 with 100,000, and that ends up being $4.16 million. So if somebody is paying you $100,000 each year at an interest rate of, if the interest rate is 4%, and they're paying you this amount every year for 25 years, that is basically the same as them paying you a lump sum amount of $4.16 million in the future at the end of year number 25. So as you can see that we are evaluating time value of money. Okay, we are going between present to future, future to present, annuity to future, annuity to present, and so on. In this lecture, we introduced the concept of time value of money and looked at present worth and future worth in detail with several examples. And in the next lecture, we will look at annuity and gradient, which are slightly more complicated concepts. For further practice, I'd recommend you to check out the quiz at the end of the lecture, and also consider the study guide and practice exams for additional practice. Thank you. If you found this preview lecture helpful, I'm confident that you will also greatly benefit from the full course that contains over 150 plus lectures and covers all the topics that are found in the latest NCEES FE Electrical and Computer Exam Specification. You will also find numerous quizzes and mini exams in this course, which will help you in getting additional practice. I have included a link in the description of this YouTube video for a free FE Electrical and Computer Exam Preparation webinar. All you need to do is to click the link and sign up. One last thing. Here's a small trailer of Study for FE's on-demand FE Electrical and Computer Exam Preparation course. Thanks for watching.